So let's us start. Right. So today we will do two things. Firstly, we will look at what kind of products we can offer to businesses. Then we will start the project. Right. I have uploaded one project which is a garment manufacturing company. So we will look at how to do the capacity calculations, P&L calculation, balance sheet and the cash flow. Then we will work on the investment appraisal methods, right? So initially I will take you through the products we can offer to any business purpose, right? Hope you can see the board properly. So in the business, we have the fixed assets, which are land, building, machinery, equipment, vehicles, right? Then we have current assets, inventory, debtors, blah blah, then cash. Then we have current liabilities, which are creditors, short-term facilities, right? These are of long-term nature, or their useful life is more than 12 months, right? Whereas these, any asset which can be converted to cash within 12 months. So that means their useful life is less than 12 months, right? So when we are financing, always as a banker, we should match the lifespan of a business asset with the funding arrangement. So always these assets are financed by term loans. Any facility which has to be paid over a period more than 12 months, right? Then these facilities are financed with short term. Any facility which needs to be settled within 12 months period, with the exception of like this, you have working capital. When we come to working capital, you have permanent working capital and variable working capital. So the permanent working capital part should be financed through term loans or term funding, right? Permanent. Whereas the variable part of the working capital needs to be financed by short term, right? So permanent part of the working capital can be financed using a medium term loan, maybe 36 months or less, right? So we are basically matching the useful life of the asset and the funding lines repayment period, right? Always remember, whenever we want to finance a fixed asset, it has to be a term loan. Whenever we are financing short-term requirements, it has to be financed by short-term funding, with the exception permanent part of the working capital, normally which is around 40% of the working capital has to be financed by long-term funding, or you even can use permanent overdrafts for that permanent part of the working capital. The balance, the variable part, always we need to finance using a short-term funding which can be revolved, right? So this is how we match the funding period and the lifespan of the asset, right? Then let us go to the handout. So this is what I spoke to you with. This is a long full handout, but I will be just taking you through the products only, right? So we have to match the product lifespan and the asset lifespan. Then we categorize the facilities into two things: direct facilities or direct advances, or indirect facilities or indirect advances, right? Direct facilities, we use the terms like on balance sheet facilities. Indirect advances, we use the terms like off balance sheet contingency facility. Indirect, off balance sheet, contingent facilities, whereas direct facilities, we use the term on balance sheet and direct facility. What is a direct facility? Direct facility is a facility when granted cash flow out of the bank, right? You give a credit card. Customer can always use the fund, take out money. You give a housing loan. Money will go out of the cash flow of the bank. So there will be money flow out from the bank, right? Then it is called a direct facility. From direct facilities, always banks earn interest income, right? What is the indirect facility? Indirect facility is a facility where there is no cash flow out. Bank take a responsibility on behalf of a third party. If the third party defaults, bank take the liability on behalf of the third party, right? Example is a bank guarantee. We have several type of bank guarantees. Most common is the trading bank guarantee, where we guarantee, we say for DSI, there is a distributor, and on behalf of the distributor, we give a guarantee to DSI saying, okay, you give credit to this customer. If he does not pay, we will pay, right? We will be paying only if the customer defaulted the beneficiary, right? It will be only when the customer defaulted. So bank is taking a responsibility on behalf of a third party. If the third party defaulted, we will discharge the third party and take the responsibility of the default, right? That is an indirect facility, like LCs, letter of credit. They are also bank take a responsibility of paying. It is a conditional agreement to pay. We will look what it is shortly. So it is indirect facilities and direct facilities. So always you can give a customer direct or indirect facilities. Direct facilities are normally long-term and short-term both, but indirect facilities are normally short-term, right? I just spoke to you about guarantees. Guarantees are used to protect this, right? Your bank guarantee amount should reflect this. We are guaranteeing on behalf of a creditor, right? If this company does not pay you, we will pay. That is a bank guarantee. Loans and overdrafts. Loans are facilities we grant with an amount, specific period, agreed upon repayment frequency and interest. Once repaid, you can't reuse a loan. Like we give a 10 million loan to be repaid over 5 years on a monthly basis, right? At an interest rate of 14% or AWPLR plus 3. So when you start repaying, you can't use. But overdraft is a limit we mark over and above the credit balance of a customer's current account. Right? It is like a bucket. You can put water and you can take out water. Similarly, you can settle and reuse. Overdrafts are limits marked over and above the credit balance of a customer's current account. There are 3 types of overdrafts: permanent overdraft, temporary, and casual overdraft. Permanent overdraft is a facility limit normally given for 12 months period. After evaluation, normally taking a collateral, some sort of a security, right? After 12 months, we will review the facility, review the operations of the current account, and may decide to continue for another 12 months period. Temporary overdraft is a short-term facility, maybe 2 weeks, 1 month, 3 months maximum. Normally, temporary overdrafts are clean basis, but with a request from the customer. May or may not have an offer letter, but customer has to request to mark a limit over and above their credit balances for 3 months period. So the customer can write checks without a fear of returning. Right? Permanent overdraft is for 12 months period. Temporary overdraft is for maximum of 90 days. We hardly give 90 days. 30 days is a normal case. Right? But you need to have a written request from the customer. Casual overdraft is not a facility. It is a privilege given to the best customers of a bank. Right? At the discretion of the management, manager decides to pay. That is without a request from the customer. He is bound to pay if we decide to pay the check. Right? It is a casual thing. Manager's discretion, you can't demand for that. You don't need a written request from the customer in order to grant a casual overdraft, maybe for 1 day, maybe for 7 days, very small periods. Indirect advances, what I told you earlier, there are 3 parties involved: applicant, our customer who is requesting, then the guarantor is the bank, and beneficiary is the party who is receiving our guarantee and who can claim the guarantee. Right? If my customer defaulted, beneficiary only can claim. Right? Once issued, applicant can't cancel during the period without the beneficiary's consent. Like if we have the original guarantee, we normally cancel, but we prefer to have a letter from the beneficiary within the 12 months period, normally within the period, right? When we issue a guarantee, we don't ask questions. It's an unconditional guarantee normally. When the guarantee is claimed, we pay within 12 months. 24 to 48 hours we pay. After paying only, we will decide how to collect from the customer. Applicant can't come and say, don't pay, I have issues. We can't listen to applicant. We have to pay and listen to the customer. Short term, long term, I discussed this part. Then type of advances, guaranteed loans, mortgage loans and pledge loans. Guaranteed loans are personal guarantees or corporate guarantee. If a person personally guaranteeing, it is a personal guarantee. If a company is guaranteeing on behalf of a customer, then it is a corporate guarantee. Mortgage loans, that means it can be a security. There are two types of mortgages, immovable mortgages and movable mortgages. When the asset mortgaged to the bank as a security can't be moved easily, then it is a immovable property. Like land, building, machinery, nut and bolted and fixed to the ground are immovable machinery. If the machinery can be moved easily, then it is a movable security. Then it can be vehicles, it can be equipment, anything. Pledge loans are the ownership of the asset which is pledged or given as security is with the customer, but possession is with the bank. Shortly, I will go more detail about the pledge loans. Consumption lending and commercial lending, that is, if the end use of the money of the loan does not generate income to repay the loan, then it is a commercial consumption lending. If the end use of the money does not generate cash to repay the loan, like personal loans, then housing loans. If you are using a loan to buy a personal vehicle, it does not generate money. Then commercial lending is when the end use of money generate money to repay the loan, right? Then it is a commercial lending. These are the types of lending we will be discussing. We have the term loans and we have the short-term loans. As I told, term loans are facilities which needs to be settled over and above 12 months period. Up to about 3 years, we say medium term. Anything above that is term loans. Term loans are given for two purposes. Starter loans, which is for startup businesses. Expansion or modernization loans for existing customers. Normally to finance fixed assets, but permanent working capital also can be financed through term loans. We give a grace period where the customer does not have to repay the capital, only the interest need to be serviced. When you borrow from a bank, from the day we give out money, you have to repay. The customer needs to repay interest because our bread and butter is money. We are what? We are just white collar money lenders, right? We lend money. So our medium of earning is money. So we give out money, so they have to repay on a daily basis interest calculator, right? So Grace period, normally the term grace period is allowed for when the loan is not loan capital is not paid, only the interest is paid, it is a grace period. The word moratorium is used when interest and capital both will not be paid to the bank for a certain period. Then it is a moratorium, right? When we discuss about the grace periods, normally for land purchases or permanent working capital purchase funding, we don't give grace periods, right? For land purchases or permanent working capital funding, we don't normally give grace period. We assume that they can repay the loan, that's why they are borrowing further, right? Then how do you decide the ability to repay a term loan? What is the calculation we do to check the ability to repay? Can someone tell me? How do you what is the calculation we do to check the ability to repay a term loan? Chat box is open, you can text.
Debt service cover ratio?
Yes, debt service cover ratio. Can someone else tell me how do you calculate DSCR? We learn those things in the class. Someone can type the equation.
Profit before financial expenses divided by total financial commitments.
Financial commitment. Need to be little broader. Can you see this part? DSCR equals profit before interest and depreciation. Not only financial commitment, depreciation minus tax, which is a statutory thing, divided by term loan capital. We'll write it up the way. Capital of term loans, interest of term loans and short term plus lease rentals. Right? This is the equation for debt service cover. Right? At least 1.5 times debt service cover is a reasonable one. But if we can have nearly a 2, you are safe. Why? We are talking about SMEs. They use the same money for day-to-day living as well. So they will eat, then they will repay. Therefore, this. But if it is more than this, right, larger than 2, then we run into the problem. They have more than enough money to repay the bank, but bank is not asking. Therefore, the business can use that money for something else. Money diversification, diversion of money happens there. They have money, but their commitment is low. Therefore, they go and invest for something else. Right? So, always 1.5 to 2 should be okay. More than that is dangerous. Right? I prefer everyone participating. Right? So long-term loans are that normally we take a collateral for security when we are lending long term. Again, did I discuss with you collateral types and not? Did we discuss about collateral? Yes, no, any answer?
No, sir.
No?
No.
See, we can use anything as a collateral. And you can take a personal guarantee. If a person is guaranteeing a facility, it is a personal guarantee. Then we have corporate guarantee. When a limited liability company or a limited company is guaranteeing, then it is a corporate guarantee. Right? Then we have fixed assets. You can mortgage any fixed asset as a collateral for the facility. It can be land and building, right? Machinery, equipment, vehicles. You can mortgage all those things. Then you can mortgage stocks or inventory or debtors. We can use those things. If the asset mortgage can be moved easily, like equipment, vehicles, stocks, debtors, we call movable security. Right? If the mortgage can't be moved easily, then we say immovable mortgages. Right? Then we have another term, third party mortgages. Right? What is third party mortgages? If the asset given as security is not my own asset or the company's own asset, it is the mortgage will be a third party one. Like I want to buy a vehicle, so I want a loan but I don't have security. My mother is giving a security on behalf of me. Then it is a third party. A company ABC Private Limited is borrowing. So the borrower is ABC Private Limited, and a director of that company is giving her or his property as security. Then it is a third party security. When the borrower and the owner of the asset, which is given as security, then we call third party. I think you did about legal recovery with Mrs. Seniviratna. She spoke to you about Parate action, debt recovery, mortgage bond, those things you spoke to.
Yes, sir.
Right.
Yes,
Then this third part issues she may have discussed with you. Right? So it is third party mortgages when the asset given as security is not owned by the borrower. So immovable and movable. Right? Then with time, asset values changes. Right? With time, asset value changes. We have two graphs. Time, value. Right? When we talk about securities, we have four types of securities. Fixed value securities. This is fixed. Then we have increasing value. Value securities. Decreasing value securities. Then we have fluctuating value securities. Right? These are the four types of securities we have. If I give you an example, fixed deposits. Cashback security. It is a fixed value security. The face value of the deposit would be the same for even 10 years. Maybe the purchasing value come down, but face value is the same. Increase in value. Land. Normally in Sri Lanka, land appreciate. Right? In some conditions, it depreciate, but normally it appreciate. Right? Machinery. With time, the value of a machinery comes down. Value of a iPhone 7 2 years ago and today. Vast difference. Right? Then fluctuating value. Inventory. Stock. Any stocks? Day to day prices changes. So this is the type of securities you have. Then if we take another graph looking at the business, time and risk. With time, risk increases. Longer the repayment period, higher is the risk. Shorter the repayment, risk comes down. That's why the risk is low at the beginning. It increases. So, based on the risk type, of the facility you grant, you decide which kind of security you need. You can have a combination of securities, increasing value securities, decreasing. Like you can have land and building plus machinery, or you can have land and building plus inventory. Like that, you can have combination. But based on the risk you have with your facility, you should decide which kind of security you are asking for. You normally don't give facilities term loans with fluctuating value security because it can get fluctuated, it can come down, or it can perish, perishable things, right? So you link the risk type to security type. So we have immovable security, we have movable security, then we have 4 types of security types, then we have the risk type on a facility. So normally we match these two when deciding on which kind of security we are going to ask, right? If the asset is owned by the customer who is borrowing and the facility amount is more than 5 million, you can go for parate. Else, you will have to restore to debt recovery action or mortgage bond action, right? So that's a very brief one, security types which you can use. Any questions on that? No questions? All of you are sleeping or what?
Sir, taking paddy as a security.
Sorry?
Paddy stocks as a security.
Yeah.
At this juncture, is it not advisable, no, for the fluctuation of prices and all?
Yeah, it is a stock, right?
Yeah, stock.
So it is fluctuating value security, right?
Yeah, yes, sir. Yeah.
So
but
normally we give short-term facilities taking
okay.
penny stocks.
Yeah. Okay. Okay.
Was that your question?
No, my question is that generally in nowadays these stock against mortgages facilities are not advisable, no, sir, regarding due to the present situation, like.
So basically, any facility against stock is not advisable.
Okay.
See,
Okay.
because stock is with the customer.
Yes.
Right? So, and it is the hardest to convert to cash again. Okay. So when a customer default, do we think that he will return the stock?
No.
That is the first to vanish. Right? So normally we don't encourage anyone to go ahead with just stocks. But based on other criteria, like, see, when we are lending, we have 5 C's of credit. Security is only the last C, right? If you think that customer is worth to give a clean facility, as a pressure tactic only, psychological barrier only, you can take stocks. Otherwise, no point taking stocks, right? But we have another mechanism to look at stocks that I will tell you very soon when I'm discussing the pledge facilities.
Okay, thank you.
Right. Anyone else? Right. අපි දැන්ට මේ වෙලාවේ කතා කළේ අපිට security ಜಾති තුනක් තියෙනවා. එකක් fixed type security, ඒ කියන්නේ අපිට ලේසියෙන් එහාට මෙහාට කරන්න බැරි ජාතියේ security. අනික් එක ලේසියෙන් එහාට මෙහාට කරන්න පුළුවන්. එතකොට machine එකක්, එහෙම නැත්නම් vehicle එකක්, එහෙම නැත්නම් stock එකක්, ඒ වගේ ඒවා movable security වෙනවා. immovable ස්ථාවර දේවල් විදිහට යන්නේ land and building, එහෙම නැත්නම් machine එකක් nut and bolt දාලා පොළොවට හයි කරලා තියෙනවා නම් ඒවා immovable security එකක් විදිහට ගණන් ගන්න. right? So third party security එකක් කියලා කියන්නේ ණය මුදල ගන්න පුද්ගලයයි security එක අයිති එක්කෙනයි දෙන්නෙක් නම්. එතකොට මේක third party security එකක් වෙනවා. අපි ඒ වගේ අවස්ථාවකදී සාමාන්‍යයෙන් කරන්නේ දෙන්නම joint borrower කෙනෙක් කරලා තමයි අපි ණය මුදල දෙන්නේ. If you come across a third party mortgage problem, we make the owner of the property and the borrower as a joint borrower. So we try to avoid the third party situation, but you can argue otherwise at courts. Right? අපි ලෝ join කරලා දීලා අපි කියනවා නෑ දෙන්නටම තමයි අපි ණය මුදල දුන්නේ කියලා. එතකොට අපි හැමතිස්සෙම මෙතන යට තියෙන graph එකේ විදිහට risk එකයි කාලයයි බැලුවොත් කාලය වැඩි වෙන්න risk එක වැඩි. එතකොට අපි ගාව තියෙන security ಜಾති හතරක් තියෙනවා. කාලයත් එක්ක value එක වැඩි වෙන එක, කාලයත් එක්ක value එක අඩු වෙන එක, කාලයත් එක්ක value එක ස්ථාවර සහ කාලයත් එක්ක value එක වෙනස් වෙන security. එතකොට අපි දෙන ණය මුදල හරි දෙන facility එක හරි දිහා බලලා තමයි තීරණය කරන්නේ කොයි වගේ security එකක්ද අපි ඉල්ලන්නේ කියලා. අපි දීර්ඝ කාලීන ණයක් දීලා තොගේ විතරක් අපේට ගන්නෙ නැහැ. මොකද තොගේ කියන්නේ fluctuating security එකක්. වෙනස් වෙන security එකක්. කාලයත් එක්ක value එක වැඩි වෙන security තමයි land and building කියන්නේ. කාලයත් එක්ක වටිනාකම් වැඩි වෙන. එතකොට අපි normally වෙන්නේ දීර්ඝ කාලීන ණය මුදලක් නම් දෙන්නේ land and building තමයි අපි security විදියට ඉල්ලන්නේ. අපිට මේක combination එකක් වෙන්නත් පුළුවන් land and building උයි machinery. machinery කියන්නේ කාලයත් එක්ක මේ value එක අඩු වෙන security එකක්. ඒ විදිහට අපිට ගන්න පුළුවන්. ඊට පස්සේ ඊට ඉස්සෙල්ලා අපි කතා කළේ direct facilities and indirect facilities කියන්නේ direct facility කියන්නේ අපි ණය මුදලක් දුන්නාම ඒ වෙලාවෙම සල්ලි බැංකුවෙන් එළියට යනවා. හරි? එතකොට housing loan එකක්, leasing එකක්, credit card එකක් ඒ වගේ. අපිට cash flow issue එකක් එන ඒවා direct facilities කියලා කියන්නේ. අපි interest income එකක් තමයි direct facilities වලදී ලබා දෙන්නේ. indirect facility එකක් කියන්නේ අපි interest income එකක් නෙමෙයි අපිට හම්බෙන්නේ fee income එක. අපි එතකොට third party එකක් වෙනුවෙන් responsibility එකක් තමයි ගන්න. අපි එකපාරටම සල්ලියක් යොදවන්නේ නැහැ. අර third party අපේ customer මොනවා හරි ගෙව්වේ නැත්නම් හරි මොනවා හරි perform කළේ නැත්නම් හරි අපි ඒ වගකීම බාර ගන්නවා කියන එක තමයි guarantee එකකින් කරන්නේ. එහෙම නැත්නම් indirect facility එකකින් කරන්නේ. හරි? හරි විනාඩියක් දෙන්න. Right.
Sir, excuse me.
Yes.
If a bank granted the facility against immovable property,
Yes.
if it is over 5 million,
Yeah.
are there any possibility to acquire the mortgage asset without going to legal action?
Yeah, that is the Parate case. In Parate, you don't need to go to courts to acquire the asset. Right?
So I mean, if it is Say inventory.
Inventory, it is very difficult because it is his premises, right? We can't enter into their premises to acquire on Parate. You have to take over the premises. Normally, Parate goes for fixed, immovable things. Sometimes when we have movable machinery and we have the access right to the machine, so whenever we are taking over securities, movable machinery type we say, always you need to take the access right to that machine. Otherwise, you can't touch a ground without the access right. Is it clear? You have taken the
Yes, sir.
machinery mortgage and you don't have the access right. You have not taken the access right to that machine. Then in case of a default, we can't keep a foot on their land. Right? So normally we go for Parate, land and building and machinery. When it goes to stocks, we can't find the stocks. Therefore, we don't go for Parate. We go for debt recovery actions. Then we go for his everything, not only for stocks. Right? Is it clear?
Yes, sir.
Right.
Sir, another question. Sorry for this.
Yeah.
We have granted loan for 6 million. Now the outstanding is 3 million.
Yeah.
Shall we go for Parate, sir?
It says outstanding, right? But we use the original approved amount and we go for Parate.
Okay, thanks.
Right? But it is a doubtful case. What is the reason for not getting an account for indirect facility loan portfolio? What do you mean by that, Chalita? What is the reason for not getting an account for indirect facility? Oh,
So if we issue a bank guarantee, that will not count to our loan portfolio, no?
No. Why? Your question is why?
Why, sir?
Because we have not utilized our money. We have just taken a responsibility, right? Because our job, our purpose of the bank is to lend money. Then you need to incur a cost by lending, right? Here we don't give out our money, our depositors' money. What we do, we take a responsibility, right? Therefore, we can't take it to our books. Only at the time of default, when the money flows out of the bank, we take to our books on balance sheet. But when the bank do all other things, what we say, we have our on balance sheet position is this, but we have this contingent liabilities we declare. Even in our annual reports, risk reports, everything we declare. Clear? Did I answer you?
Clear, sir. Clear, sir. Thank you.
Okay.
So other thing, we grant term loan of facilities for companies. Shall we
Right.
transfer the immovable property to the company names? Otherwise, it is treated as a third-party mortgage.
Yes, it is. Say, it is a very circulating one. Initially, it was not third party. When the directors owned, it was not third party, right? Then Jayavardhana, HNB versus Ramachandra, I think, it became third party. Then Jayavardhana versus HNB, it again became not third party. Now, as per the moment, due to the case between Mudit Perra versus DFCC, directors' properties are third party. So always advisable to transfer it to the company. But
Excuse me.
yes.
So recently I saw that court case against Yashoda in that building construction.
Yashoda Holdings
Yashoda
and
Yashoda Holdings. It's a third party.
Now that is came to the final verdict has given, no sir?
Yes, Yashoda Holdings. They have seized the property of the director, one of the directors, no?
But it has not become a case law, as per my knowledge.
Oh.
Recently, about one month.
Okay, because still it is not published as a case law.
Yes, it's not published, but the verdict is that. So,
okay, then
we
in the future we may.
Yeah, it may.
Yeah,
but
because
that
current,
case also. That
sorry?
case also for a long-standing case. I saw the entire
over 10
case
years, I
published
suppose, no?
over
Yeah,
10
sure.
years. And
Yes.
it's some extraordinary thing only, then it is declared as a company property. Thereafter only they have judgment given in favor of bank.
Bank, yes.
Okay, so
BOC People's Bank, I suppose.
what it happens now is we have to make it a case law, and then the bank should use that, right? Because last one was Mudit Perra versus DFCC. Since this is a new development, we will take it. We'll have to take it as a case law, because if they go and appeal and something like that, we can't do anything. So it has to come out as a case law, right? As per my knowledge, up to yesterday, it was third party, right?
Yes, sir.
But if the verdict was differently, it will become again a regular asset once it is come out properly. Okay.
Okay, thanks.
So for the moment, what we do best is to transfer it to the company, but it involves cost. Therefore, what we do, we make them joint borrower, director and the company. Right?
Director and the company means we have to execute the mortgage bond like that. Otherwise, we have to.
Yeah, it is a director joint borrower facility.
The facility joint to sir. Otherwise,
Facility is a joint borrower facility. Both the company and the owner will sign on the mortgage bonds.
Company and the director.
Yeah. It has to be directors. Completely a third party, we should not encourage.
Oh, yes. Okay. If a director is a property owner,
Yeah.
owner of the property, then
You can make them joint borrower and take it as a mortgage. Then you don't need to look at the third party issue.
shall we grant the facility like that? Company and the director as joint, sir?
Sorry?
Company and the director as jointly shall we grant the facility, sir?
Yeah. If you grant the facility, director and the company jointly, then we avoid the third party issue as of now. But if this new development comes in, you don't have to worry about it.
Okay, thanks. Okay.
Right? Currently, what we do, we jointly grant the facility. Okay?
Okay, sir. Okay.
Right. Then I have another question. What do you mean by the access right earlier? That means you have a land. We say we have a land. It is not mortgaged to us, but there is a machine here fixed. If this is not mortgage, you can't just walk and touch this machine. You should be allowed to go and access that machine. Right? That's why land also, you have a road here, right? But if you don't have a proper access, this land is useless. Right? Access right is when the property is not mortgaged, we are allowed to go and inspect or do whatever with the machine which is mortgaged to us. Did I answer your question, Madhuvanti? Okay. Right? So that's about security.
So one more quick question, sir.
Yes.
Coming back to Parat action, let's see, we have granted a facility initial 6 million and then the outstanding is 3 million. So, however, due to the arrears portion, the bank has rescheduled outstanding 3 million again as a new offer letter with a new offer letter. So, what is the position of taking the Parat action for that?
See, Parat action, it says outstanding, right?
Okay.
But we use the original facility amount.
Okay.
Okay. When we reschedule, always we refer to the original agreement. In case of a default, original facility agreement valid.
Okay.
Right? Therefore, we go on the original facility agreement.
Right. Okay. Thank you.
Okay. Anyone else? Right. If not, I will go back to the presentation. You can see the presentation, right? I'm in the presentation mode. Yeah. Right. So that is this. Then we will go to short term. Right. Short term facilities. We have different types. Whatever the type is, our repayment needs to happen within 12 months period. Right. We use the working capital cycle to decide the period for short-term facilities. We calculated working capital periods, inventory turnover period plus debtor collection period minus creditors payable period. That is how long actually money is held in the business from acquisition of resources to collection from customers. So using the working capital period, we decide whether to give a 3 months facility, 4 months facility or 1 month facility. Right? Short-term facilities are any facility which needs to be settled within 12 months period. Right? Then again it can be subdivided into short-term revolving. That means we give a facility today based on the working capital period. We have to repay it 4 months. Once you repay, you can retake the money. It is a cycle. You repay, again limits available, you can take. For 12 months period, it continues. At the end of the 12 months, we review the facility performance and extend. So that is a short-term revolving line of credit. Or if you give a facility where 12 months, within 12 months you pay and settle it off, that is also short term. Right? So always when it is short term, we talk about revolving facilities. The period decided by the working capital cycle, right? Or the known cash flow. Working capital cycle or known cash flow, right? First one is channel financing. Look at this. This is the two sides of the same coin. Right? We have a corporate. We take it as DSI. My normal example, DSI. You have a customer who is a shoe manufacturer, right? Then this customer comes to you and asks for you are his banker, and he will come and tell you, sir, I have a order for 700,000 rupees, 70,000 pieces. I want 500,000. Are you comfortable to give 500,000 for this customer for maybe 2 months, 3 months? How comfortable are you? Don't think much. How comfortable? Right? Normally, we are a little uncomfortable when a customer straight away comes and asks me, can I have this much amount? Why? We always fear SMEs will take out money and put it somewhere. Or will he perform the order? That is the performance risk and money diversion risk. We are worried about that whenever we talk about SMEs, right? But if this customer comes to you and tell, I have done an order for DSI, I am a supplier to DSI, I have produced 70,000 pieces, which is equal to 700,000. This is the GRN received from DSI. This is the agreement DSI will pay within 45 days. Can I have 500,000 to do my next order? Then as a banker, we know the amount, how much this customer will receive, then the date when this money will be received, and now we are not talking about the SME, we are talking about a corporate, DSI. Normally we assume that corporates honor their payments, right? Now you are not looking at SME risk, now you are looking at DSI or corporate risk. So you are looking at known cash flow, right? You are looking at known cash flow. You know the amount, you know the period. So based on that, I am comfortable to lend him 500,000, right? This side is called supplier side or supplier financing. Any supplier to a corporate, once they supply the goods, normally corporates take credit, 32, 62, 90 days credit. SME will have to wait and see, wait for the money. So there will be a working capital requirement for this customer. Therefore, taking hold of the GRN, agreement to send money to your bank account, we can lend to this customer, right? That is called supplier finance side of the channel finance. Please tell me, is it clear to you? Supplier side of channel finance. Is it clear? Some few others, please. Rasika, thank you. Can I see some other answers? If not, I will explain again. Okay. I have one query, so I will re-explain. It is like this, right? අපි ගමු example එකක්. මම කාර් ගිල්ස් එකට එළවලු සප්ලයි කරන එක. මම ඇවිල්ලා ඔයගොල්ලොන්ට කියනවා මට ඕඩර් එකක් තියෙනවා ලක්ෂ 5ක් දෙන්න මට මේ ඕඩර් එක සප්ලයි කරන්න. එතකොට බැංක කෙනෙක් විදිහට මට ෂුවර් නෑ වැඩි. සල්ලි ටික වෙන කොහෙට හරි යයිද? එහෙම නැත්නම් මෙයාට බඩු ටික සප්ලයි කරගන්න පුළුවන් වෙයිද කියලා බයක් ඇති වෙනවා. ඒ වුණාට ආපහු තව එක්කෙනෙක් ඇවිල්ලා කියනවා මම කාගිල්ස් එකට එළවලු දැම්මා ලක්ෂ 7ක මෙන්න ඒගොල්ලෝ බඩු බාරගත්ත ක්විතාන්සිය එහෙම නැත්නම් GRN එක මට සති දෙකකින් සල්ලි හම්බ වෙනවා. මට ලක්ෂ 5ක් දෙන්න දැන්ට. එතකොට කාගිල්ස් එකෙන් ලියුමක් තියෙනවා මෙයාට ලක්ෂ 7ක් ගෙවනවා සති දෙකකින් ඒ සල්ලි අපි හිතමු බැංක් ඔෆ් සිලෝන් එකේ මෙන්න මෙයාගේ තියෙන මේ account එකට අපි එවනවා. එතකොට අපි දන්නවා බඩු ටික බාර අරගෙන හොඳ තත්ත්වයෙන් බාර අරගෙන ඒක GRN එකත් එක්ක GRN ಜಾති දෙකක් තියෙනවා එකක් තමයි චෙක් කරලා බාරගත්තා අනික එක චෙක් කරන්නේ නැතුව බාරගත්තා. චෙක් කරලා බාරගත්තා නම් සාමාන්‍යයෙන් ඒගොල්ලෝ රිටර්න් කරන්න බෑ. හැබැයි චෙක් කරන්නේ නැතුව බාරගත්තොත් ඒගොල්ලෝ රිටර්න් කරන්න පුළුවන් ඒකාන්ත ප්‍රවේශම් වෙන්න ඕනේ. right? මම බඩු බාර අරගෙන තියෙන්නේ දැන්. එතකොට අපි හිතන්නේ බඩු ටික හොඳ තත්ත්වයෙන් බාර අරගෙන තිනවා ඒකාන්ත කාගිල්ස් එක සති දෙකකින් අනිවාර්යෙන් සල්ලි ගෙවයි. කාගිල්ස් එක කියන්නේ කෝපරේට් එක normally කෝපරේට් එක කියන දේ කරනවා කියලා අපි assume කරනවා. right? එතකොට SME risk එකෙන් පිට කරනවා. එතකොට අපි මේ එන්න තියෙන සල්ලි ටික බලාගෙන අපි ලක්ෂ 5ක් දෙනවා. ඒක තමයි සප්ලයර්. මම කාගිල්ස් එකේ සප්ලයර් කෙනෙක්. නැත්නම් DSI එකේ සප්ලයර් කෙනෙක්. right? ඒකට කියන්නේ අපි supplier finance කියලා. right? Is it clear? Samira? Right. So I'll take another example. I am a supplier to Cargills. Right? I supply vegetables to Cargills. Then I come to you saying I have supplied vegetables for the value of 700,000. Then this is the GRN. After 14 days, Cargills will pay to my account with your bank 700,000. So I'm okay. We have shifted from SME risk to corporate risk. We assume that corporate will honor their payments properly. Therefore, we are okay to pay. So we are looking at a supplier to Cargills, any corporate. So that kind of facilities are called supplier finance, right? Okay, then we will go to the other side. Then this side is called distributor side. That means now the supplier has given to DSI. DSI is not giving everywhere to sell. There will be agents, again SME, right? There will be distributors or agents. DSI will give goods to these agents. Agents in turn sell to smaller businesses, right? DSI gives agent with 1 month credit. In order to enjoy that credit, this agent needs to give a bank guarantee to DSI. There has to be an independent bank who guarantee the payment for DSI. Based on that, DSI will give goods to the distributor. Then distributor will go everywhere and sell the goods. We have 3 types of payment modes. Firstly, the cash. Secondly, bill to bill. Thirdly, post-dated checks. We discussed these 3. Bill to bill means we just sign on the bill after when I have to come back. When I go next time to the shop, I will get my previous bills money and I will give goods again. Post-dated check means is the check dated in the future, right? Now what happened? This distributor will have working capital requirement. Why? You have to give credit to the market. But at 30 days, you have to pay the corporate. So in this kind of a scenario, what the bank can do, bank can take hold of those post-dated checks. Right? Why? Post-dated checks means his cash flow. Customer like ABC company, customer. They have given us 1 million worth of post-dated checks of 200 customers. 1 million worth, 200 customers. Right? So the risk has been dispersed. Api risk එක බෙදිලා ගිහිල්ලා. Right? So we will take those checks and we will give part of that amount. If we get 1 million, we may give 70%, we may give 80% based on the average check return percentage we reflect. Right? In both cases, we don't give the profit ratio, net profit amount of the customers to them. Right? We consider only the cost parts. We say when we analyze the customer has net profit margin of 20%. Then always the discounting factor would be less than 80%. We don't give the profit to their hand upfront. Hari? Api supplier කෙනෙක් වගේම distributor කෙනෙක්ගෙත් මොකද වෙන්නේ? ඒ distributorට corporate එකෙන් සල්ලි ගන්න බඩු ගන්න නම් අපි bank guarantee එකක් දෙන්න ඕනේ. bank guarantee දුන්නාට පස්සේ ඒගොල්ලෝ බඩු දෙනවා. දීලා ඉවෙලා distributor ගිහිල්ලා හැමතැනම බෙදනවා. බෙදුවාම ඒගොල්ලොන්ට එක්ක cash හම්බෙනවා. එහෙම නැත්නම් bill to bill එක හම්බෙනවා. එහෙම නැත්නම් post dated check එක හම්බෙනවා. එතකොට මේ customer ට working capital requirement එකක් එනවා. එතකොට එයා මේ post dated checks ටික ගෙනල්ලා බැංකුවට දුන්නොත් අපි දන්නවා මෙයාට හරි මෙච්චර කාලයක් ඇතුළත මෙච්චර මුදලක් එනවා කියලා උදාහරණයක් විදියට මාස දෙකක් ඇතුළත 1 million rupees එන්න ඕනේ මේ post dated checks වල value එක 1 million සම්පූර්ණ ටික realize වෙන්න ඕනේ හරියට ගියොත් within 2 months. අපි බලනවා මෙයාගේ පහුගිය මාස 6 කොහොමද check return සාමාන්‍යයෙන් 102යි 3යි 4යි 5යි නම් අපි 80ක් විතර දෙන්න පුළුවන්. අපි මේ දෙන ගාන කීයක්ද ඩිස්කවුන්ට් කරන්නේ කියන එක තීරණය කරන්නේ අපේ net profit margin එක බලලා අපි කොයි වෙලාවෙවත් profit margin එක කස්ටමර්ගේ අතට upfront දෙන්නේ නැහැ. right? මෙතන checks තියෙනවා අපි හිතමු 1 million වලට 200ක් විතර check තියෙනවා. ඒ කියන්නේ ගොඩාක් අය අතර risk එක බෙදිලා ගිහිල්ලා. හරි? එතකොට අපිට ප්‍රශ්නයක් වෙන්නේ එකක් දෙකක් return වුණා පොඩි amount එකක් තමයි return වෙන්නේ. මේ 1 million තියෙන check දෙකකින් නම් we have a issue. One check get returns, we have a issue. Right? That is called dispersing the risk. That is distributor side of the coin. Right? So, any questions on that? Distributor part. These checks should be written in the name of the business entity. We don't use personal checks. Business checks විතරයි ගන්න පුළුවන්. Any questions? Yes, no, good, bad. ප්‍රශ්නයක් තියෙනවා නම් අහන්න ටක් ගාලා. නැත්තම් මෝ කියලාවත් දාන්න. These are things you can do for a customer who walks in. Right? Right. This is the distributor side, supplier side. Then we have factoring. We will break for a quick tea by 3:15. It is 2 minutes to 3. We will come at 3:15 sharp and we will start from here because I need little time for this. Maybe 5-10 minutes for this. So we will meet at 3:15 sharp. Right, let me start. We are at factoring, right? This is one way of financing short-term working capital requirement. This is the definition for factoring. I'll just read it out for you. Factoring is defined as the continuing legal relationship between financial institution, the factor, and the business concern, which is the client, selling goods or providing services to trade customers, the customers. We have three parties: factor, client, and the customers. On open account basis, whereby the factor purchased the client's book debt, account receivables, either with or without recourse to the client, and in the relation thereto control the credit extended to customer and administer the sales ledger. Right? This is the definition for factoring. Okay, let me explain. Right? We have customers, we have our client, right? Then we have the bank or factor, right? This is the factor. Factor, client, and customer, right? So customer sells goods to, this is our borrower, right? So it is the client. In normal course of business, this customer sells goods to his or her customer. Then in return, they will get credit notes, bill to bill, GRNs. Like that, we will get some sort of a supporting document for the purchases these people have done from him, right? So since he is selling on credit, he or she or the business will create working capital requirement. Under factoring, what happens is the bank will analyze all these customers, right? And say, okay, we have A, B, C, D, E, like that. There are so many customers. Bank will go through these customers' details and he'll say, okay, we are good. Okay, this customer is good. This customer is bad. This one is good. This one is good. This one is bad. We are okay to give you money if you sell to this customer, and this customer. If you sell to B and E, we can't do anything. We are not giving you money, right? Again, bank will say, okay, if you sell up to 500,000 for this customer A, we will give you money. For C, it is 250. So D, it is 1 million. Like that, bank will decide how much bank will give for each customer. So the borrower's sales is managed by the bank. Bank will tell to whom you should sell and how much you should sell. Right? Bank will decide on these things. Then what can the borrower do? Now they get the GRA. They will hand over the GRA into the bank. Right? In return, bank will give money, cash, to the client. Right? On the due date, customer need to pay the bank, not the borrower. Why? When we are doing the factoring, this invoice, goods invoice, should mention bank name and instruction to pay to the bank. Right? So now in factoring scenario, once we approve the customers, borrower can sell to those customers mentioning this invoice will be discounted by this bank and money should be paid to the bank. So we say it is 30 days credit. Right? On the 30th day, bank will contact this customer and get the payment collected. Right? We have two words, recourse, non-recourse. Right? Factoring is basically non-recourse. If this customer does not pay on the 30th day, bank can't go back to the client and ask for money. They have to bear the NPL or bad debt. Right? So this is the factoring mechanism. Initially, they just sell each other and client will have working capital requirements. So in order to solve the working capital requirement, we have an instrument called factoring, where and how it happens is the client will come to the bank, the factor, and tell, I am selling goods to these customers. Then bank will go through the customer list and say, okay, these customers are acceptable to us. If you sell to these customers, we will give you money upfront. But This customer is good only for 500,000. This customer is good for 1 million. This customer is good for 200,000. Like that, bank will have limits for each customer. So with this, bank is controlling the client's sales book. We are doing the sales accounting. If this customer goes and sell more than 500,000 to this customer, bank is not liable to give money. That is his problem. If they go and give goods to B, that is his problem. Bank is not responsible. If these guys play within the given guidelines, new GRN will have to mention the bank name, instruction to pay to the bank and all those things. Client brings the invoice to the bank, bank gives money upfront. Then on the 30th day, bank will collect from the customer, not from the client. Right? If the customer default, bank will not go behind client. They will have to deal with this customer for recovery. That is called non-recourse. We are not going back to client. We are assuming the bad debt. So this process is called the factoring. Right? There's another thing what we just discussed was supplier finance or invoice discounting. In the invoice discounting, borrower does not need to disclose that we are discounting the invoice. So at the 30th day, customer will have to pay to borrower. Borrower in turn settle the bank, and non-recourse thing goes out, then it will become recourse. Right? Customer will not get to know that borrower or the client has discounted the bill. Right? It is a normal transaction. He pays the borrower, borrower pays the discounter. That is supplier finance or invoice discounting. When it comes to factoring, customer will get to know his invoice has been discounted and money will be collected from the bank. Okay. Supply finance also, this kind of arrangements will happen. We will evaluate the customers. We will place individual limits. The difference is we are not going behind the customers. We are going behind the client. He will not get to know that we have discounted. Right. Any questions on this? We are not giving the full amount. We will have to keep money for our interest and charges and everything. Based on that only we are giving money. Any questions? No questions? Everything understood? Don't think twice. If you have a question, ask. Right? මෙතනදී factoring එකේදී කරන්නේ අපේ බැංකුවේ බරෝ ඉන්නවා. අපි හිතමු ඒ මිස්ටර් පෙරේරා කියලා. එයා බඩු විකුණන සෙට් එකක් ඉන්නවා. බැංකුව තියෙනවා. right? මෙයා සාමාන්‍යයෙන් බඩු වික්කහම GRN එකක් හම්බ වෙනවා. මෙයාට ක්‍රෙඩිට් දීලා දින හන්ද මාසයක් දෙකක් යනවා සල්ලි එන්න. ඒතකොට working capital requirement එකක් එනවා. මෙතන factoring වලදී කරන්නේ බරෝව තමන්ගේ customer base එක බැංකුවට දෙනවා. එතකොට ඒ base එක බලලා බැංකුව කියනවා මේගොල්ලෝ හොඳයි අනික් අයට අපිට මුකුත් කරන්න බෑ කියලා. ඊට පස්සේ ඒ හොඳ නම් එයාට කොච්චරක් දෙන්න පුළුවන්ද? C ට කොච්චරක් දෙන්න පුළුවන්ද? B ට කොච්චරක් දෙන්න පුළුවන්ද කියලා අපි තීරණයක් ගන්න. ඒතකොට බැංකුව තමයි තීරණය කරන්නේ Mr. Perra කාටද විකුණන්න ඕනේ? Mr. Perra ඒ හැම එක්කෙනෙක්ට කොච්චරක් විකුණන්න ඕනද කියලා. ඊට වැඩිය වික්කොත් ඒක Mr. Perraගේ ප්‍රශ්නයක් මිසක් බැංකුවේ ප්‍රශ්නයක් නෙමෙයි. ඊට පස්සේ Mr. Perra බඩු විකුණනකොට ඒ ඉන්වොයිස් එකේ දාන්න ඕනේ මේ බැංකුවෙන් ඩිස්කවුන්ට් කරනවා ඒක හන්දා සල්ලි කෙලින්ම බැංකුවට ගෙවන්න not to me කියලා. හරි? එතකොට Mr. Perra ඉන්වොයිස් එක ගෙනලා බැංකුවට දුන්නාම ෆැක්ටරට දුන්නාම එයා සල්ලි දෙනවා. අපි සල්ලි දෙනකොට ඉන්වොයිස් වැලියු එකම දෙන්නේ නැහැ. අපේ charges, fees, interest ඒ ඔක්කොමතම ඉතුරු කරගෙන තමයි දෙන්නේ. ඊට පස්සේ ඩියු ඩේට් එකේදී අපි කස්ටමර් ගෙන් තමයි සල්ලි ගන්න. එයා ගෙව්වේ නැත්නම් අපි Mr. Perra පස්සෙන් යන්න බෑ. මෙයාගෙන්ම අය කරගන්න ඕනේ. ඒක තමයි අපි non recourse කියලා කියන්නේ. අපි මෙයාට බලපෑමක් කරන්න බෑ. bad debt උනොත් අපිම තමයි විසඳ ගන්න ඕනේ. ඒක තමයි factoring කියන්නේ. ඒතර අපි ඉස්සෙල්ලා කතා කළ supply finance එකයි factoring එකයි අතර වෙනස තමයි supply finance එකේදී customer දැනගන්නේ නැහැ එයාගේ invoice එක discount කළා කියලා. එයා මාසෙකට පස්සේ සල්ලි ගෙවන්නේ clientටම තමයි. client ඒ සල්ලි ගෙනල්ලා බැංකුවට ගෙවනවා. හදිස්සියෙන්වත් මෙයා සල්ලි ගෙව්වේ නැත්තම් ඒකේ අපේ loan එක ගෙවන එකේ වගකීම තියෙන්නේ බරවට අපි මෙයාගේ පස්සෙන් යන්නේ නැහැ. හරි. ඔය දෙක තමයි වෙනස තියෙන්නේ. ප්‍රශ්නයක් තියෙනවද? Any questions? If everything is clear, can I know whether it is clear? Yes, Indika. I just got 2 answers. We have 17 people in the class, only 3 answered. No? Right. Bank will have to go against the legal action. That's why bank normally does not do factoring. Factoring is done by specialized companies. In the factoring acts, we have different ways of legal recoveries because it is on the invoice you have to pay to the bank and giving the bank the full authority to collect money from the customers. Right? By signing on the invoice, they agree for that term. Okay, Indika?
Okay.
Right. So just go through same things are there. Invoice discounting, this is what I discussed. Check purchasing is basically overnight or just a day's thing. We get a check, we call the other bank, get it verified, we call freight confirmation. Once a check is given the freight, normally banks, this is bank's ethics, we don't return those kind of checks. However, recently we have faced situations bank given the freight, still they have returned, which is not acceptable by bankers' ethics. Right? So when it has to be normally a corporate check, personal checks are not entertained under this. Business checks, I mean to say business checks, and once we have to check with the other bank, issuing bank, whether cash availability and acceptability of this customer. If they give the freight, they should not return. So pending the realization, we charge 0.5%. So that is a very lucrative business, but very dangerous business as well. Then post-dated check discounting, that is the distributor side of the channel financing part, right? Just a small clarification on that. PDC discounting. PDC discounting. Right? We do few things. Check the check return percentage. Right? We say 5%. Then we take, what does this mean? If you give 1 million checks, we assume that 50,000 checks will get returned, right? So 950,000. Okay, we work on the check return percentage for the last 6 months, right? This is the meaning of that. Then we get a cash deposit. We say we are getting a 10% cash deposit. What does that mean? We have 100,000 cash, right? 100,000 cash. Right? So, when we discount, or like we say, put it this way, when we have 1 million checks, if we give 850,000 for 1 million, that is 85,000, 85%, you are safe. That means we are 15% check returns also we can accommodate. Right? We have counted for 5% here. We have cash of 100,000. So even if your checks are returned by 15% return, you can recover all your capital. Therefore, your discounting rate would be 85%. This is how we decide the discounting percentage. When we decide the discounting percentage using the average check return percentage and the security percentage, we will look at net profit percentage as well. If the net profit percentage is 20%, we will not give 85%. We will give 80% or less. Why? Anytime we are not giving the profit margin to the customer. So we may give 80 or we may give 75%. What does 75% means? Even if 75% of the checks get realized, we will be okay. Right? Is this clear how we decide the percentage to be used in check discounting facilities? We get the average check return for 6 months period. We get what is the possible security position. Then we will decide this is we expect that from 100,000, normally 5% will get returned. So this is 5%. Then we have cash. Even if check returns during the cash, within the cash, we have no issues. So it is 850, then it is 85%. Then we will check net percentage, net profit percentage. If it is 20, we go below 80. Else, if it is 10%, we go for 85%. Right? That is the PDC discounting percentage. Is that clear? Hurry up, we have to finish this. If not clear, please let me know, I will explain.
Sir, can you little bit explain about the net profit scenario?
Yeah. So we don't give the profit margin to the customer at any given time, right? So based on this scenario, we decided we can give 85%. Then we will check the net profit margin. We say it is 20%. Then the cost is 80%. Right? So if you give 85, you are giving 5% profit margin to the customer upfront. Therefore, we will discount only 80% or less. Clear?
Yes, sir. Yes, understood.
Right. Anyone else? No
why
question.
do you
Yes.
reduce that cash deposit percentage from the limit percentage? Is there safety margin also?
It is the safety margin. That's
Oh,
right. So
that's
you
safe.
have, even the checks get returned, you have that
return
coverage.
return percentage, okay, sir. That is a risk. But this is a
Yeah.
cushion, no? Cash
Yes.
deposit margin.
You have the return percentage, right? Then we have the cash deposit, right? Even if checks get returned within the cash deposit, we are okay.
Due to that, you have reduct, no? Okay, sir. Okay.
Yeah. Right?
That means we have allocated some limit to the checks get returned. No?
Yes, we are allocating a cushion to return the checks.
Okay.
Right? We are financing the
Now,
minimum
okay.
amount. Right? Even we get 25%, 30% return, we are safe in this case. Right? Is it clear?
Yes, sir. Clear.
Now it's okay, sir. Now it's okay.
Right. Okay. Right. Then we will go. We have a few more things to do. Then we have the pledge loans. Right? we have pledge loans, right? We have a customer or borrower, then we have bank, right? So what happens here under pledge, I will take the paddy pledge, which we discussed in the morning, in the earlier hours of the day, right? So this is a paddy miller. He wants to buy paddy, and he does not have security to offer to the bank. Okay, bank is ready to give money, but they need security. What happens here? We give money to buy paddy, right? We give him money, cash, to buy paddy. Once the customer buy paddy, he will bring this paddy to a store, right? Which is controlled by bank and customer both, right? So though we have given money, the goods are not in the hands or possession of the customer. It is in the possession of the bank, right? Paddy, buy paddy stock here, stock in this warehouse, right? Whenever customer wants some paddy to be released, we say he wants paddy of to the value 100,000, right? He needs to pay 100,000 to bank. Then bank will release 100,000 worth paddy to the customer. Once payment received only, bank will release the paddy, right? අපිට බැංකුවේ ඉන්නවා, customer ඉන්නවා. customerට we ගන්න සල්ලි ඕනේ. හැබැයි customerට බැංකුවට දෙන්න මේ අපයක් නැහැ. ඒතර බැංකුව කරන්නේ සල්ලි දෙන්නවා we ගන්න. ගන්න we ටික warehouse එකක store කරනවා. store කරලා ඒකේ control එක තියෙන්නේ බැංකුවේ. එතකොට අයිතිය තියෙන්නේ customer උනාට බඩු ටික තියෙන්නේ බැංකුවේ. එතකොට බඩු ගන්න ඕනේ වෙලාවට customer බැංකුවට සල්ලි ගෙවන්න ඕනේ. සල්ලි ගෙවුවාම බැංකුවෙන් ඒ සල්ලි ප්‍රමාණයට හරියන්න මේ ප්‍රමාණයක් එළියට දෙනවා. ඒක තමයි ownership customer, bank, possession bank, right? අපිට අර stock එක තියාගෙන දැන් මෙතන බඩු ටික customer ගාවම තිබ්බොත් stock එක මෙතනම තිබ්බොත්, if the stock is with the customer, bank does not have any control. He can sell and he does not need to pay. But when the stock is with the bank, he can't do that, right? It is under the control of the bank. If he does not pay during the agreed time, bank has the right to sell these stocks. That is called pledge, right? Famous pledge is paddy pledge in this country, but we get robbed always because there will be another door somewhere, they take it out. Or they show us instead of paddy, paddy husk, right? දහය දාලා ගෝණිය වල අපිට paddy කියලා දෙනවා. ඒ වගේ වැඩ අපිට හරියට කරලා තියෙනවා බැංකුව. But the other famous pledge is the vehicle pledge, right? When we had imports, we see a lot of vehicles coming into the country. Vehicles are parked at the customer, but documents are with the bank. Without import documents, they can't go and register in the RMV. So bank holds the documents. Whenever they want to sell a vehicle, they have to come and pay or give a delivery order from a reputed bank or a finance company or something, and take the documents, right? Always release will happen once money comes in only. That is pledge. Bailment of goods for funding. Any questions on that? Currently, I am doing a pledge with a third party. Like goods are, I pay for goods, then goods are delivered to a third party, right? Whenever they want, the customer wants part of the goods, they have to pay me the amount, then I give instruction to the third party. It's Haley's Adventist, I think. I give to the third party releasing order. Then only they will release. Okay, any questions?
Is it pawning is another way of factoring, sir?
Pawning?
Yes.
No. Pawning is asset-based financing.
You are sure, no?
Yeah. You can term it because the goods are given to us, right? But we don't term pawning as a pledge, right? It is asset-based financing.
Little while ago, you told that third party, what do you call pledge? Is that outsource company handling the stress of our stress
on
to
behalf
them?
of us. Yes.
On behalf of us. We have to pay to them more, otherwise customer
No,
have to...
I got the customer to pay them.
Okay.
So my agreement was you have to pay their rentals and everything, but the protection of the goods is under their custody. Only upon my instruction, they can release goods.
Okay, if anything happened to that stocks, who will liable, that customer or that company?
Third party company. In their custody, if something goes wrong, that is the third party company.
Then who are
So
the
we have
holders?
insurance.
Even that customer payments also routed through that third party company to us,
No. Customer has to pay to us first. Then only I will.
We will give an instruction to them.
Yes, release order.
Then the key holders?
Huh?
Keys?
No, there is no key. Third party custodian company is responsible for the goods. Right? I am not holding any key. They are prohibited of giving goods to the customer unless until I instruct them.
Then banks operational parts are very less, no?
Yeah, I don't have any operational thing. I get money. When I get the money, I will instruct the third party to release. That's all. At any time, they can come and pay us and take. Otherwise, we have to go. We have to wait till they take out the goods. We have to make sure that they are taking only that amount. All operational activities I have outsourced.
In the initial terms, how we can value the stocks? That's our response, or that outsource company's response?
When this happened, this is a specific good. When they got the goods into their warehouse, they checked the goods, the condition of the goods, and they gave me a report saying we received this much of goods. The value and everything we knew. The goods and the quality they checked.
Okay, sir. Okay, thank you. This is a new thing, no?
Yeah, actually we created that one because normally what happens is always we have a store, we have 2 keys, we go there, clear the things and like that. Since we can't do it here, we created that model. Right? When building a stock like that, to whom bank release the cash, seller or the borrower? See, best is to settle it to the seller, right? Because then we know that money is purely used for the purchasers. Otherwise, what happens is we give 100,000, he will buy less. Because unless until we get the money, goods in, we don't have a control. Clearly?
Yes, sir. But their cost.
Huh?
What about their cost? Transportation
Their-
cost, stores should bear by borrower.
They have to bear. That is at the borrower's expense. Because we are giving goods without any security or anything. So they have to agree to maintain, pay the renters for the things, insurance and everything. Like my customer is paying something like 100,000 at the moment, but it is a 500 million facility. Monthly basis, he is paying around 100,000 for the rent out premises.
Okay, sir.
Right? Anyone else?
Is this like a escrow agreement, sir? No.
Escrow agreement, yeah, you can term it like that. Escrow agreement is the bank, a developer, and a buyer come together, right? So buyer gives money to this account where the customer, who is the manufacturer or the vendor or the contractor, can't take out money without the authorization from the bank, right? Bank will have different milestones when to release the money. That's the escrow agreement. Only on agreed stages we are releasing money. But here is we are releasing goods. Okay.
Okay, sir. Okay.
Due to operational difficulties, we hardly do these pledge loans now. But we have created the new way. Banks should be able to work around.
But we have to find a good outsource company, no, sir?
Yes, you have to find a reliable outsource company. Otherwise, both of them get together and rob us. So that's why we went to a reputed company. Even my buyer was agreeing to give his own warehouse, which we didn't agree, because we may have to go in the night. We don't know how much he will take out, all those counting, and then it will become our responsibility. Right?
Is the goods parked at that the outsource company's store, no?
Yeah, it's outsourced companies too.
Maybe that this is a little expenses to the borrower, no?
Yes, there is expense to the borrower, but then it is, though there is expense, he has a freedom. He does not need to give us security. Those additional benefits are there. Yes. Then I'm also comfortable that funds will, goods will not go to the customer than taking a stock mortgage.
So, but there is a huge operational risk, no?
I don't have operation risk. Why?
But when I think that third party, now he is the control of the keys, no? He can play with the goods, no?
Yeah.
Now, what I mean is that operational risk means that third party can take out the goods from the stores, but no one is there for responsibility, not even the customer knows and the banks. So
no, we are not giving to everyone. No. We have to give it to a reputed
but what I'm saying is there is a huge operational risk, no? That when it comes to,
so we have to tackle those things. We have an agreement with them. We have an agreement with
there might be an agreement. Yes, I can understand. But you know, if that third party moves that stock out from the, you know, when we are going to a visit or something, then we can see that suddenly some stocks are missed. So customer can say, "Api gatte naha, now it's your bank responsible."
It
You
is
know,
the responsibility of the third party. On the agreement, they
yeah,
agree
that's
for
what I'm
the
saying. That
same.
there is a risk, no?
There is a risk always. Even if you keep it in the bank's safe, there will be a risk. No?
But one key is with us, no?
Then
We are handling the keys, no?
you are handling the keys. How many times bankers have robbed from our own safe?
No, I
There is a
think
point.
if the keys are handling by the banks,
There, you
that
know,
is the most risk situation.
that's the most risk.
Yeah,
No,
there is a risk.
giving
So
responsibility to a third party is less risk to the bank.
less operational work to the bank.
Yes.
Operational work is less. That's correct.
Less, right? Again, we are not giving it to a third party per se. It has to be a reputed third party, right? That's why we have choose Haley's Group, which is one of the best companies in the country.
So Haley's works as the third party.
Third party. So we have to cover up ourselves. Otherwise, third party and the borough will get together and rob us. Right? We have to cover up ourselves. So the agreement binds the third party for the protection of the goods. If something goes wrong, we can go to courts against the third party.
Yeah. Insurance and all other has to be done by Haley's, third party.
Third party, but it will be cost to the borough. Right? Otherwise, if we say stock mortgage, what can you do? It is not in our control at all.
Yeah. Stock mortgage and pledge are different, no, when it comes.
Yeah, stock
mortgage, we don't have the yes.
The options are we take a stock mortgage or we take a pledge.
Yeah.
Right? Stock mortgage goods are with the customer.
Customer, we don't have any control.
We don't have any control. If he does not pay, we have to go to courts and say that he is not paying. Oh, court order එකක් ගන්න වෙනවනේ. හරි? එතකොට වැඩක්ම නැහැ.
නෑ ඒතකොට බඩුත් නෑනේ.
බඩුත් නැහැ. අපි යනකොට අරගෙන විකුණලා ඔක්කොමත් ඉවරයි.
රටින් ගිහිල්ලත් ඉවරයි.
හරි? එතකොට pledge එකේදී at least we know goods are there somewhere. හරි දැන් වෙලා තියෙන්නේ අපි ගොල්ලෝ pledge එක කළා ලංකාවේනේ. ගොඩක් බැංකු කළා. ඒ වුණත් දැන් ඒක ඔක්කොමලා වගේ නවත්තගෙන එනවා. මොකද වෙන්නේ? warehouse කොහෙන් හරි ප්‍රලමක් කරනවා. අපිට එක දොරක් පෙන්නලා තව දොරකින් බඩු ටික ගෙයි. ඒක එහෙම නැත්නම් මේ පැඩි ගෙයලා 10 යවනවා. අපිට ලොරියක් ආවම ගෝඩි කීපයක් චෙක් කරනවා මිසක් අපිට බෑනේ ඔක්කොම චෙක් කරන්න. But when we go to a warehouse, third party, we can instruct them to check everything and take. Right? Clear then?
Yes, sir.
Right. Okay. Anyone else? Any other questions? If no, we'll go to the other one. This is the bailer, pledger, the borrower who is giving the goods to our custody. Bailee is the bank. Ownership is borrower. Possession is with the bank. Right? Then it is the hypothecation loan. These kind of facilities nowadays we don't do due to documentation issues, documentation problems. Right? Here, what happens is goods are with the customer. Ownership also customer. But on documents, he agrees to return the goods whenever we ask. Right? So charge against good for an amount of debt where the ownership nor the possession is passed to the customer. The good remains in the possession of the borrower and the equitably charged to the lender under documents. Right? If he does not pay, we can demand him to return the goods. is liable to return the goods. It is again different from stock mortgage. Stock mortgage, it is not liable to return, right? Pay, or we have to go to courts and prove and take. Here it is, he is liable to return the goods. That is called hypothecation loans. Right? It is a one type of loans. Then we go to trade finance, right? When we talk about trade finance, we have two types of trade finance. It is the internal trade finance and external or international trade finance. Internal means within the country, buying and selling. International means cross-border buying and selling. In either case, we need to find a supplier, we need to find the suitable pricing and the quality and the ability to provide the quantity, quantity and price and suitable supplier. That is a normal scenario in local trade as well as international trade, right? So, yeah, so we'll be talking about this part first, right? International trade, you can go through this. There are three types of, basically this is a lengthier and full handout. You can have a look, just go through it for your knowledge. But I'm going through the products itself, right? There are three types of relationships in international trade. First one, unaffiliated, unknown parties. Second one, affiliated, unaffiliated, known parties. Third one is affiliated parties. Unaffiliated, unknown means we have not dealt with the other party, right? So we need some sort of a contract. We need a contract for buy and sell, and we need a protection against the non-payment, right? Second type is unaffiliated, known. That means we have dealt with the other party, so we need a contract to buy and sell, but we may not need a hard-coded protection against non-payment, possible protection against non-payment. Whereas affiliated party, we don't need contract, we don't need protection, right? Because we know the other party, it is an affiliated party to us. Then when it comes to importers, always what importer prefer is to get the goods to the hand, importer's hand, and settle. When it comes to exporter, what the exporter prefer always to get money to his hand and then to export. So there is a trade dilemma because of that. One party, the importer in this country, wants to get the goods to Sri Lanka before selling, paying. The person who is in India wants to get money before sending the goods. In order to avoid this issue, a bank comes in between, right? One. Right? We have three things. Unaffiliated, unknown, unaffiliated, known. affiliated. Right? Here we want contract. Payment guarantee, possible payment, and no payment guarantee. These are the three types of people we will have. Right? In order to solve this issue, we have letter of credit. Right? In order to solve this issue, we have documentary credit. This is covered under open account. Right? These are the three methods of type of people we'll meet, and these are the solution issues and expectations. These are the possible solution methods we have. Right? We have India, we have Sri Lanka. This is our border. Right? Then we have New Delhi, Mr. Saravana Muthu, and here State Bank of India. We have BOC here, Mr. Pereira. Right? These are the people. Okay. So now Mr. Pereira wants to buy 100,000 kilos of basmati, right? A grade, kg, at a price of 200 rupees a kg. Right? This is the requirement. So if this is the type, Mr. Pereira does not know Sarvanamuthu in New Delhi. He is here, but he found out that, okay, documentary collection, Madhuvanti, right? Right? Mr. Pereira does not know Mr. Sarvanamuthu. He get to know a deal. So what he does, through Bank of Ceylon, his bank, he gives a promise to Sarvanamuthu saying that you send these goods to Mr. Pereira in Sri Lanka, right? And submit these documents. The bank undertake to pay. So it is a conditional undertaking to pay. Letter of credit is a conditional undertaking to pay. Right? Under letter of credit, bank does not take any responsibility on the goods coming in, goods in the container or whatever, right? So Mr. Pereira comes to the bank, take the request for bank's conditional promise on behalf of Mr. Pereira to Mr. Sarvanamuthu to sell the goods. So what the Bank of Ceylon does, Bank of Ceylon will inform the correspondent bank, State Bank of India, to tell Mr. Sarvanamuthu there is a person called Mr. Pereira who would like to buy Basmati A grade 100,000 kilos at this. You ship the goods to Colombo and provide us the following documents. If the documents are in order, Bank of Ceylon is ready to pay. Right? That is the letter of credit. Right? For importation. So when Mr. Saravanamuthu sends the goods to the harbour, documents, goods will physically come to the harbour, documents will come to the State Bank of India and to Bank of Ceylon, BOC. Bank of Ceylon will go through the documents and the LC application. If everything is okay, the BOC will pay money to State Bank of India. Right? If there are differences between the requested documents and the documents received, we will contact Mr. Pereira and say there are issues, discrepancies on the documents. Are you okay to accept? If he says he is okay to accept, we will pay. Otherwise, we will return the document saying these documents are descriptions. Right? These documents are defective, so we can't pay because we are dealing with document. Right? We are dealing with documents. So on LCs, we have two things: site, users. Right? Site means as soon as good documents received, we check the documents and we will pay. Right? That is site LC. Users LC means Mr. Pereira gives 30 days credit to, Mr. Sarvanamuthu gives 30 days credit to Mr. Pereira. So what we will do, we will go through the documents, we will check the documents. If the documents are in order, we will ask Mr. Pereira to sign bill of exchange. Right? That is, okay, after 30 days, I will pay. Then we will send the document. On the 30th day, without waiting Mr. Pereira to pay the bank, we will send money. Subsequently, we will collect it from Mr. Pereira. That is usance LC. Mr. Saravanamuthu is giving Mr. Pereira 30 days from the bill of lading, BL. That means Naunagi me Sahatiki. Right? That means the goods are shipped from the date of shipment. Right? 30 days. So on the 30th day, bank has the responsibility to settle Mr. Saravanamuthu. We can't wait for Mr. Pereira to pay. If Mr. Pereira does not turn up also, we have to pay. That is the responsibility of the bank. Under LCs, bank is responsible for the payment if the documents are in order. If there is any discrepancy, bank is not responsible. We want Basmati. If in the container, if it is cow dung, still we can't do anything. We have to pay. Right? Because we are dealing with documents. If the documents comes perfect, we can't do anything. That is letter of credit. And two types of letter of credit is site and usance. We have two documents, bill of exchange and BL. BL is bill of lading. Any questions on that? That is another product we can give to customers. Letter of credit. Any issue, anything? Everything clear? Hurry up.
Yes, sir.
Okay. What about others? 2, 3?
Yes.
All, yeah. Always the same people are answering. Right. Okay. So that is for unaffiliated, unknown parties. Then we will come to unaffiliated but known parties. That means Mr. Pereira and Mr. Haranamuthu had been dealing with long time each other. So they know them, each other, they know the payment patterns. So what they do, instead of a payment confirmation, they can go for documentary collection, which is DAODP. Right? They will send, right, this in the international trade, physically goods comes to the customs border, but the ownership comes through the documents. Right? Without the documents, you can't go and clear the goods from the customs. Right? Though the physical goods comes to the customs, ownership to the physical goods lies with the documents. Right? So what happened under the second category is Mr. Saravanamuthu sends goods to the Colombo port and the ownership documents are sent from State Bank of India to Bank of Ceylon. What Bank of Ceylon will do is, we will call Mr. Pereira and say, there is a set of documents which has come on behalf of you. You have to, if it is DP, you have to pay us this amount and collect the documents. Right? Documents on payment. DP is document on payment. Right? If the customer pays us, we will release the goods. Release the documents. If he does not pay, after a few days, we will send it to Mr. Saravanamuthu saying that my customer is not collecting the documents. We can't do anything. Right? Then other way is similar to the LC users. Mr. Saravanamuthu has given 30 days credit. So that is documents on acceptance. Right? So what we do, we call Mr. Pereira and say, there is a set of documents for you. Please sign the bill of exchange. That is the agreement to pay after 30 days and take the documents and go. On the 30th day, we will ask Mr. Pereira to pay the bank. So we can in turn send the money to Mr. Saravanamuthu. Right? If he pays well and proper, we will send the money. If he does not pay, we can't do anything. We are not responsible. We are not liable to pay. We will tell the State Bank of India, this customer is not paying, we can't do anything. Right? That is DA. We release after some time, depending on the credit period, we will contact the customer and try to collect the money. If they don't give, we can't do anything. We will inform the other party. Third category is affiliated and no payment guarantee required. That means goods will come to the customs, document will go straight to Mr. Pereira. Right? No bank involvement. Open account. Documents will go there, goods will come here. Mr. Pereira can go to customs and clear the goods. Right? No protection either side. If Mr. Pereira want to send goods to Mr. Sarvanamuthu, he has to come to Bank of Ceylon just to remit the money. OTT, outward remittance. Right? That says open account. Under this, bank is liable to pay. Here, bank act as a post box. We just transfer documents. If he pay, we pay. If he does not pay, we can't do anything. Open account, bank does not have anything, right, to do. Okay. Though we say DA, we don't have any liability. Yes, we don't have any monetary liability when we are dealing with DA documents. But we have a reputational risk when we are dealing with documents. If all documents which comes to our bank is not getting paid, we have a reputation risk. State Bank of India will refuse to send documents to our bank, saying whatever goes there does not get returned. So it is not a reliable bank. So normally DA documents are handled for known customers only. Walking customers, we don't do DA documents. DP you can, because only on payments we release the document. Because as long as documents are with the bank, Sarvanamuthu has the ability to take the goods back or convert it to another customer. These documents can be transferred among the banks. It comes to NDB. Then if the customer wants to transfer it to a Sampath bank, you can transfer through the approval of this person. Right? Then we have another thing called shipping guarantee. Right? Under this category, we have another thing called shipping guarantee. What is a shipping guarantee? Shipping guarantee is when the goods are here, but documents has not come in. Right? Original documents has not come. Documents, we have two sets of documents. The original sets come from State Bank of India to Bank of Ceylon. But the duplicate set or the copy documents comes through the shipping agent. When it comes through the shipping agent, it is not original, we can't release. But banks give a guarantee to the shipping agent saying, okay, you go ahead and release the goods. Right? That is a risky business because we are releasing a document saying that it is a DA. Right? Subsequently, it comes as DP. Then we have an issue. We release the document saying $50,000. Actual comes to 75,000. We have an issue. Right? So it is risky. So we take up to around 300% cash. 300% guarantee when we are issuing a shipping guarantee. That is to release the goods without the original documents comes in. Then have another thing called custom duty guarantee. That is, we have some goods imported to the country to add value and re-export. In that process, we don't charge duty. Right? If the customer does not export the goods we receive to the country, bank will honor the duty payment. That's the custom duty guarantee. That's all from the international trade point of view. Any questions on those slides?
So on the shipping guarantees, if the bank is issuing a shipping guarantee, is there any payment liability to the bank at the maturity date on the due date?
Yes, we have a liability. When you are issuing a shipping guarantee under LCs, you anyway have a liability, right? But even if it is a DA document, when we are releasing on a shipping guarantee, there will be a liability for the bank, right? It is like avalization, where like avalization is we confirm the payment. Similarly, as per the international trade, if you issue a shipping guarantee for a DA document or DP document, bank is liable to pay, right?
What if the issued shipping guarantee has been cancelled and is the payment liability still remains?
Sorry?
When the original documents comes,
Yeah.
the shipping guarantee can be cancelled, no?
No, but still you have issued the goods before seeing the original documents.
Okay, that means the shipping, even the shipping guarantee is cancelled, we have to pay.
Yes. I have a detailed argument with trade guys these days on this. They confirm that we have a delay. I don't know the exact coding under which code we are liable, but we are liable.
Yes, I also have the same experience. This was.
These days we have different experiences due to the dollar situation.
Yeah.
Right?
As they have informed, the shipping guarantee is informing the shipper that they are releasing the goods on based on the shipping guarantee. So that's
why we are giving away the ownership. We are allowing the shipper to release, right? So we don't know what will come next. That's why we take 300% security. Normally, shipping agent can claim up to 250%. Right? Because there were cases, copy documents came for $50,000, original came for $100,000. Right? That kind of things happen. Yeah. Any question?
When it comes to avalization,
sorry,
how avalization documents?
Avalization is, see, DA documents we don't guarantee. No?
Yeah.
If the customer pay, we send you money. But under avalization, we confirm the payment on behalf of the customer.
Okay.
Right?
Okay.
That's called avalization.
Okay, sir.
Okay. Any other questions before I go to the other part? If no questions, I'll go to the post-import finance, right? Like any way of this, we will have to pay, right? LCs, okay. We have LCs paid. Now customer needs some time to repay. So we are giving a credit facility to pay the LC, or we are giving a credit facility to pay the DP bill or DA bill. Anyway, right? So this credit facility is called post-import finance. Different banks use different names. I use the general term post-import finance, right? We get the goods, we release documents, and payments happen through bank's funds. We give the customer 30 days, 60 days, 90 days to repay the loan. How we decide the 30 days, 90 days, 60 days is based on the working capital cycle, right? So when we work out the working capital cycle, it comes to 120 days. Then you need to give the post-import finance for 120 days, right? So within this 120 days, this customer gets a use and LC. If the use and LC is for 45 days or 60 days, your working capital cycle is 120. You get usance period for 60 days. So your post-import finance period would be only 60 days, right? If your usance is 120 days, you don't give post-import finance, right? DA also the similar. Your working capital cycle is 120 days. If DA is for 90 days, you give another 30 days. If DA is 60 days, you give another 60 days. But we will give only up to the working capital cycle, not more than that. By working capital cycle reflects when the money comes out of the business, right? That's called post-import financing. Is that clear how we work out the post-import finance? Right? That is post-import finance. When you are working out a LC limit to a customer, right? How are you working out the LC limit? We will have from the date of ordering, purchase order date, you will have a manufacturing time, manufacturing or processing time. Then you will have voyage time. That means shipping time. Then you have the working capital cycle, right? We say 30 here, 30 here. We say it is 120. So basically, from the date of opening decision of purchasing, it will take 180 days to get the money, right? So what we do here is we need to have LC lines for this 180 days. Why? We need to open one LC here, then other LC, goods for the other LC should be on the voyage, then other LC on the working capital line, right? So we say if your annual purchase cost of goods sold is 360 million, right? 360 million rupees. Your LC requirement would be 180 million. This is the LC line, not the PIF, post-import line. Right? Post-import is required only from here to here. Right? Post-import line should be 120, 360 divided by 12. 120. Right? So when you are working on the LC lines for a customer, you have to consider from the time of placing the order, how long it will take to process the order, then shipping time, then working capital cycle. So 30, 30, 180, it is 180 days. Right? So you need to have LC, several LCs open prior to you get your money to settle the LC. Right? So what we do, we get the annual cost of goods sold divided by 360 into 180, 365 into 180 number of days. You will get that figure. Right? Similarly, for PIF, you will work out the requirement based on number of days on the working capital. We don't want money here. We will need to use money only between these two lines. Right? So it is 360 divided by 12 is per month. This is the amount. So 120 is 4 months. It is 120. So if you can have a limit like this, that should be sufficient. 180 million LC line and 120 million PIF line. This is how you work on the LC line and the PIF within which. Right? This is how we calculate. Any questions on this? How to calculate the LC lines for a customer? You have to get these two. Add the figures, add to working capital divided by 360 into number of days. Right? That is the amount for LCs, because we have to open several LCs before getting our money back. But actual money requirement is less than the LC requirement. That is worked out using the working capital period. Any questions? Everything clear or not clear? Are you there?
So can you repeat?
See, on LC lines, how to calculate the amount of the facility we need to give for LC opening, right? So you have a processing time. You make the purchase order. You tell, I want this. You place the order. Then there will be a manufacturing time or processing time. It takes 30 days to produce the goods. Then another 30 days voyage time, that is on the ship, it will take another 30 days to come to Sri Lanka. Right? Then from the date of payment, we have receiving goods and all, we have working capital cycle. Right? So when we are looking at the total LC line to be given, it is 30 days plus 30 days plus 120 days, which is 180 days. Then we will get cost of goods sold, right? Divided by, normally we use 360 or you can use 365 into 180. Right? It will give you the amount of facilities we need to give to open LCs. LC limit is this. Then how much of money you need to give is 360 or cost of goods sold divided by 360 into 120. Right? This is the amount of post-import finance you need to give. So within which your facility limit is 180. You can open LCs up to 180, but for settlements we are giving only 120. That is called PIF limit, within which the LC line. Is it clear now?
Yes, sir.
All others? Right. Then we discuss shipping guarantees, we discuss LC lines, we discuss PIF, custom duty guarantee we discuss, availization we discuss. Right. Yeah, there is another thing. Trust receipt loan, TR loans. Like PIF, post-import, similar type of thing is called trust receipt loans. Here, goods are consigned to the bank, but we have given the goods to the customer to sell and settle the bank. It is a short-term facility to finance the post-import part of the import business. Here, goods will be consigned to the bank. We have given the goods to the customer on trust, right? He should sell and settle the bank. That is the trust receipt loan. If the customer sells the goods and does not pay the bank, it is going to be a criminal offense, because breach of trust is a criminal offense in this country. We have trust receipt than just the normal short-term facility. Trust receipt loan is a very good tool, protective tool, but it is very difficult to operate this. Therefore, there are a lot of legal documentation for that. Therefore, banks currently does not operate this. But we have something called TR loans, similar to hypothecation loans. I covered all these things. What I discussed was the import side. similar to the same export side, we have pre-shipment and post-shipment. That means you get an order, right? I am an export of cinnamon. I get an order from UK to export 2 containers of cinnamon, which cost me around to the value of 10 million rupees. Right? I'm not sure about price, just say 10 million rupees. My cost would be around 7 million, the direct cost. Right? I don't have money to do this. In order to process this purchase, do the processing and pack and make it ready for the export, we need money. The funding given for that purchasing, processing and packing part is called packing credit facilities, right? Normally we give the direct cost to the customers under packing credit. That means cost of goods sold, that amount we are giving, right? Then once we get the goods ready, we ship. Once we ship, we have the export documents. So goods has gone out of the country. Now it is the importer's risk we are taking. So what banks does, we take the original or copy documents of the export documents and discount them, those export documents. But discounting rate depends on the net profit margin. If net profit is 10%, we will discount up to 90%. We say we have an order where gross profit margin is 60%, 40%. So as a packing credit, we give from the purchase order 60%. Then once the goods are ready and shipped, we give 90%. We deduct our 60% earlier given and balance 30% we give it to the customer. Right? That is the e-bill discounting. Once the remittance come from the abroad on the export, we will clear our dues, collect all the charges and interest and return if anything left. That is called export financing. You have packing credit lines, which is to do the packing and processing and purchasing and all those things. Then once we export, once the goods goes out of the country, we will give a e-bill discounting, and the discounting higher amount need to be used for the administrative expenses of the company. That is export side of the business. Bank guarantees, we have construction guarantees, we have bid bonds. Wherever you are bidding for a tender, we need to have a bid bond. Then we have performance guarantee. That bank guarantees that my customer will perform as per the bid requirement, as per the tender requirements, right? If the contract is given as per the tender contract specification, my customer will do the job. If not, we will compensate. Then you have advance payment guarantee. That means to start any work, the authority will give some money, right? So the bank needs to guarantee that customer will work for that amount. Otherwise, we will honor that payment, return that payment. That is called advance payment. We have bid bonds, we have performance bonds, we have advance payment guarantee. Then we have retention guarantee. Whenever we say we are doing a road, customer complete part of the road and put the first bill. From the first bill, the authority will keep 5% from the bill. That is to cover for any workmanship defects, right? That means road is completed, but after few days, there is a problem with the road. Now it is a workmanship defect. So in order to cover that, we keep 5% of each bill. So out of the total contract, 5% will be kept for around 1 year, right? So if the customer wants to get that money, bank should give a guarantee. That guarantee is called retention guarantee. That money is called retention money. That guarantee is called retention guarantee. If the customer need to maintain the road or the building or whatever they have done, we have to give a maintenance guarantee. Normally, performance guarantee will be converted to a maintenance guarantee. Those are the types of guarantees we have under bank guarantees on top of the trading bank guarantee, which we normally do. Big issuer guarantee saying you give credit to this customer, we pay. These are construction guarantees, bid guarantees, advance payment, performance bond, maintenance bonds, and retention bond. How to decide on the export? I have a question. How to decide on the export facility limit requirement to the client? It is based on the this way. It is based on the cost of goods sold again, and the percentage to be discounted is again on the same lines, right? What we do, we work on the annual exports, and based on the annual exports, we will decide how much they need to process the orders, right? If annual exports is 400 million, gross profit is 360 million, and each order processing is 3 months. We need to have 360 divided by 3, right? That is 120, not 120, 150 million, right? 360 divided by 3, 120 million, right? So that is to get the orders, because you need 3 months to get the order done. So at least 3 months amount we need to give, right? That's how we work on the amount to be given. You work on the total revenue, you work on the cost of goods sold. Based on that, you decide the this amount, how much packing credit you need to give. Is it clear? Right? Okay, thank you. Yeah, was I? Bank guarantees. Any questions on bank guarantees?
So on settling the packing credit loans,
Yeah.
Once the export has been done, we discount the export bill.
Yeah.
90%. So can we normally then we are recovering the packing credit loan to the export loan? No?
Yeah.
Can we recover the interest for packing credit loan from that proceeds
Yeah.
also?
Yeah, can.
Okay.
Because we are giving the balance part for all the administrative work. So packing credits is finished.
Okay.
Right? So you recover the interest and all the other charges on behalf of the packing credit. Right? But we don't collect the interest for e-bill discount. That happens only when the money comes in.
Yeah, at the time of settling the loan.
Yeah. Right?
Right.
Okay. Any other questions? Right. If no questions, I will go to asset-based financing. This is leasing, right? We have two types of leasing, financial leases and operational leases. Financial lease is a fully payout lease. That means we select the vehicle or equipment on behalf of customer select and we buy it on behalf of the customer and allow the customer to use, right? Customer select, we buy and allow the customer to use. The ownership, absolute ownership lies with the bank, lessor. Customer can pay the money we have given to buy the loan, buy the asset, and the related expenses over the period of time. At the end of the period, he can buy the asset completely, right? So that is financial lease. It can be vehicles, it can be machinery. Absolute ownership lies with the bank. As long as customer service the bank, he is allowed to use the asset. If he does not pay the bank, we can repossess the asset saying it is our asset. Or even we can go to criminal courts and say he breached the trust, we have given him on trust, he has breached the trust, right? It is a criminal offense. That is a financial lease. Operational lease is we select the vehicle and we allow the customer to use. Customer is just paying a rent and using our own vehicle or machine. If he does not want, he can return the vehicle to the lessor. Whereas on the financial lease, you can't return. Lessee can't return. Because bank purchased this good purely on behalf of him. Therefore, they can't return. But on the operational lease, it is bank has purchased and we allowing someone to use. It is not a fully payout lease. By the end of the period, everything may not be covered. You can give it to someone else for another period, right? It is operation lease. Maintenance is the problem of the lessor. Financial lease, maintenance is the problem of lessee, the customer. And that is the difference between operation lease and a financial lease. Then we earlier had hire purchase. Normally it is for registered vehicles when we don't have VAT for registered vehicles. But since we have VAT for everyone, we don't use hire purchase now, right? There also we allow the customer to use the vehicle or asset over a period of time they pay. The difference is when the customer pays 75% of the renters, absolute ownership goes out. Then it will become like a mortgage, right, in hire purchase. That is this. Then other two things are project lending and loan syndicate. Loan syndicate is for larger loans where some company wants a 2-3 billion loan. One bank does not want to take that big risk. So what happens? They evaluate the project and share the project with all other banks. Whoever is willing to participate, they will come together. right? Jointly, several banks financing a project is loan syndication. There will be an arranger who is the initial bank who is arranging all the lenders. For that, we will take a fee, right? Everyone will have common right, that is primary concurrent mortgage on the project assets, but everyone will not go and try to collect from the business. One bank will collect everything and distribute among the other syndicate partners, right? That is a combined banks together financing a project. Then we have project financing. Project financing is financing infrastructure or large commercial projects based on projected cash flows. When we did supplier finance or post-dated check financing, discounting, we base on known cash flows. When we are looking at project financing, we base on future projected cash flow. Look at a solar farm. In a solar farm, we predict the future cash flows using the sunlight, number of units produced, what will be the cost, like number of units producing in the future, and what will be the selling price. Like that, we predict the future. And based on that, we will do the calculations and decide on the repayments and the loan amounts. If something goes wrong, we will take over the project and give it to someone else. We will not go behind the owners or sponsors of the project. We are not lending based on the strength of the sponsors. We are lending purely based on the merits of the business. That is called project financing. Right. That's all. Any questions?
So regarding documentary collection, any risk to the bank to handling direct BA documents?
Direct BA?
Yeah.
The problem is we don't know whether it is true or not. But only thing a bank has sent. If the customer directly send from that customer to customer, it becomes an open account.
Okay.
Right?
Yeah.
There is a risk. Yes.
Okay, sir.
Right. Any other questions? If no questions, I'm done for the day. We will look at start the projection next week. I have given you the assumptions. From there, we will start from scratch and do a projection for a project. This is a manufacturing project. We will do that. Then we will try to do a agriculture project subsequently, not a detailed projection, but this is the detailed projection. In your final project also, you need to do the similar thing. Right? If you don't have questions, I'm fine. Thank you.